Beating the market can be a very difficult thing to do, particularly if you want to do it on a fairly consistent basis with costs that aren't excessive and with some rules that you can understand. One way to do it is a quality factor ETF. Just simply select the companies with the best metrics, and then hopefully over the long term, these will outperform the cyclical and low margin businesses that you never much liked anyway. How do we find the best quality factor ETF? Well, we go to the website justetf.com, select ETF screener, select equities, equity strategy, fundamental quality, find the best returns after 5 years, and here we've got the UBS US quality factor. We look at the matching indices to check that we've selected the right one. Some of these indices are sector neutral, which will dilute the quality factor and dilute the returns that we're going to get. So if we just select straight USA quality, we again get UC99, the UBS USA quality factor, and that's the one that we want to analyze. To show the performance of the ETF, we'll just click on its details, select performance. We've got the chart here, select GBP, then we'll add a comparison by USA, including dividends, and then here we go. So we've got 250% for the quality factor, 212% for the index. So overall, we've got outperformance. Now I go for detailed comparison of ETFs, pulls them up alongside each other, got all sorts of information here, and then we've got some annual performance here and some performance across several years. So the quality factor doesn't outperform every single year, but its performance is good enough. So we're going to look at it in a bit more detail. The quality factor is just a subset of the underlying index, which is about 25% of the companies, about 30% of the market capitalization. And I call it the filet mignon of the index that it's looking at, in this case, the S&P 500. Here are some attributes that a quality factor can potentially bring to your portfolio to build in some resilience in the face of good price performance. You apply the principles of Pareto to investing, then 80% of the returns will come from 20% of the stocks. And I believe that these stocks are more likely to fit within the quality factor than the junk factor. We should remember that the S&P 500 is probably the most robust index in the world because it has a committee that decides who's going to be within the index in terms of new admissions, and companies have to have 2 consecutive quarters of profits from their core business before they're allowed to join. So it's a much stricter hurdle than other indices. Here are the variables within the quality factor ETF. I'll let you pause the video and you can look at them in more depth, but they're basically return on equity, so decent margins, debt to equity ratio, so not too much debt, and earnings variability, which is aimed to screen out cyclical companies. A composite quality factor will then be produced. Companies at the upper end of the scale will have a greater than their market capitalization weighting within the ETF. Companies at the lower end of the scale that might ultimately be ejected from the index will have a lower than market cap weighting. So if they are moved out, there'll be less volatility in the underlying index. Let's have a look at the top 10 positions within a US quality factor ETF. So they're capped at 5%, and then there's rebalancings in November and May. So as at the end of May, Nvidia had a weighting of 5%. The price has since grown, so it's now at 6.64% of the quality factor ETF. Then we've got Meta, then Microsoft. And then these are the top 10 largest positions within the S&P 500, with Apple at 7%, Microsoft at 6.5%. So it's interesting to see that Tesla doesn't make it into the top 10 of the quality factor ETF, and neither does Berkshire Hathaway, possibly because it'll have some quite strange metrics around it. Here we've got the sector exposures of the quality factor in the S&P 500. So the quality factor is overweight things like information technology and healthcare, which are sectors that myself and Terry Smith think are great. And then it's underweight things like real estate, utilities, and energy, sectors where the long-term performance isn't that great. So it's quite useful in terms of the exposures you're getting that will hopefully drive superior long-term returns. The ticker for the UBS USA Quality Factor ETF is UC99. If we put up the fact sheet, we can see things like there's over $1 billion of funds within the ETF, and the management fee is 0.25%, which is not that expensive, but it is kind of pricey compared to a bog standard S&P 500 ETF. Here's a comparison of the US Quality Factor ETF with Fundsmith. And what we can see is that the Quality Factor ETF does what it says on the tin, whereas Fundsmith potentially has some style drift. So where Fundsmith gets it right, there's a very close correlation between the two funds. And then when Fundsmith isn't quite so good at picking the winners, then its performance drifts a bit, and we can see that the Quality Factor ETF has made new highs in 2023, whereas Fundsmith has not. So with the Quality Factor ETF, you're getting lower fees, more reliable performance as well. Remember Peter Lynch with his book One Up on Wall Street? He used to run the Magellan fund from Fidelity. If you wonder how well it's doing now, here's the answer. And the answer is that it's actually fairly average. It's underperformed the index, and it's pretty much at the average of the category that it sits in. And so I would say, bring back Peter Lynch, look at all the outflows here. You're paying quite a lot of money for an active fund that was once good and now is definitely off the boil. And something like a Quality Factor ETF, you're paying lower charges, you can understand it a bit more, and you're getting better performance. MSCI produce a series of factor indices, and we can see here how the quality factor performs in terms of value, size, momentum, and yield. And what we can see is that small cap and value would pair well in terms of lower correlation with the quality factor, whereas momentum wouldn't, because you'd probably get quite a lot of overlap in terms of holdings and performance. In this chart, we've got the global index tracker in red. We've got a worldwide quality factor index in blue, but because that's sector neutral, it's cancelled out most of the outperformance. And then the US unfiltered quality factor is in orange. I know people are worried that the US is overpriced, but I do feel that that is where the better quality companies are with the most exciting growth prospects, and that is kind of reflected in their PE ratios. Got the idea for this video from Tom's personal finance channel. It's well worth checking out. With every fund, there's always a downside, and if you can't find the downside, then you haven't done enough research. With a quality factor, there's no valuation filter, so stocks are admitted no matter what the PE ratio is, and hence we see quite a lot of Nvidia in the ETF. So you're not really getting growth at a reasonable price. You're getting growth at arguably the highest price. But for growth at a reasonable price to exist, there has to be anomalies within the large cap stocks, which is probably less and less likely as time goes on. The US Quality Factor ETF can fit within the holy grail of investing, which comes from Ray Dalio. It looks at price growth, it looks at drawdowns, and it looks at correlations between the funds in your portfolio. If you're interested in exploring this further, then I offer a portfolio coaching service, details in the description. Here are some stats for the S&P 500, the US Quality Factor ETF, and a Global Quality Dividend ETF, GGRG, from Wisdom Tree. And what we can see is that compared to the S&P 500, the quality factor has a lower dividend yield, a higher P ratio, and about double the price to book ratio. The latter is because quality factor focuses on strong returns on equity. So if the book value is low, then you will get a good return on equity. The Quality Dividend Growth ETF potentially has more defensive characteristics, and again, it's probably more diversified because it's investing all around the world. If you want to know more about the Wisdom Tree Global Quality Dividend Growth ETF, then it's featured in this video, which I recommend you check out next.